I'm going to show you a webinar that I've done for the 5%ers, and it's part one of 3 webinars that I'm doing.
Wait. Matron, take them away.
And a warm welcome to one and all. And if this is your first time here, I'm the big fella. That is the Scruffy Trader. Must be true, because it says so right here on my t-shirt. And sitting next to me is the little tinky winky person, Winky, because she's only about that big. She's only tiny.
I'm not.
She is. She's 5 foot nothing. And I'm 6 foot and 20 stone. So it really is the yin and the yang.
You're taller than I imagined.
I'm bigger in every department.
But you're not here to talk about my marital status. Then again, you might be, because let's be honest, my life's about as chaotic as it gets.
You serious?
But are my charts chaotic? And is the way that I trade chaotic? No, it's not. And the webinar I'm about to show you is, as I was saying, part 1 of 3. And today's on journaling. And then the next webinar I'll be doing is on risk management. And then finally, it'll be a strategy for the 5%ers, guys. Now, if you're unfamiliar with the 5%ers and who they are, let me show you. They are a prop firm. Now, originally, I didn't want to be involved with prop firms, if you asked me this 2 years ago. But I do moderate the Scruffy Squad, and if you're interested, there's details below, where I help the guys, and they wanted to try a funded account. And the only way that I can give advice is if I've done it, because I always speak from experience. So I contacted the 5%ers, I read through their T's and C's, and I decided to go with the program. And as you've seen, if you go through my journey over the last couple of years, I passed it on a number of occasions, and I started another fund for them a couple of weeks ago, because he asked me if I would test and sort of work, and I'll show you that. And in fact, I'll show you that now, just so that you can see what it is that I'm doing. This is an account I started 12th of the 7th. It's now the 22nd of the 7th. And that's grossed 9 grand in 10 days. And there is my equity curve. I haven't lost a trade out of the 23 that I've taken. And 21 of those 23 are deemed profitable and sustainable. That's what this section here is.
Good job.
This is going quite well. And for the other accounts, when people ask, do you get paid? Yes, I do. My payments are starting to come through now. There's another 500 came in last night, and as you can see, there is multiple payments through it. So I've got a lot of time for these guys. But who are they and what do they do? Well, as a prop firm, they're one of the better ones that are out there. There's loads, and I get contacted all the time from various different ones, and they offer to pay me a lot of money to endorse them, and I always turn them down. I do this for the 5%ers free. I do it because it's my guys in the Scruffy Squad that wanted to try it, and that's why I do it. But I was that impressed with them, I stuck. And then when they saw my results, they asked if I would help their own internal traders, and that's what I'm doing, and I'm pleased to do that. So what we can see here is at the moment they have 2 offerings, which is a boot camp, where if you haven't got a lot of money and your skill set is pretty much almost there, you can go into the boot camp, pass the 3 challenges, and you've got plenty of time because you've got a year to do this. They will give you a big funded account of 100,000. Now that's pretty good. And then you can trade that up to 4 million in stages. And that's life-changing, guys. That is genuinely life-changing. And then you have this here, which is instant funding. Now, these are the models that I prefer because you are live in the market from day one. And at the end of the day, it doesn't cost you a lot to start. You know, you can come in at 235. You'll have instant funding of 6K. And then again, you can stage that up to 4 million. Or you can go the route of 80,000. So if you're going to put a small amount into a broker, you can put that small amount into this prop and use their money and then use the profits to enhance your own broker. That's kind of the way that I look at this. And if you come back to my stats that I was showing you earlier on, there is the registration point for members of the 5%ers. So if you're interested, there is a link down below, and they've been kind enough to give me a discount code to use as well. So you get 5% off those buy-in fees. Stretch your pennies out a little bit further. So let me show you the webinar. Enjoy it. Do comment on it. I'm always interested in your thoughts, etc. And if you want to try the 5%ers and see the next 2 webinars, click on the link as said, and you'll be able to register. So enjoy.
Guys, welcome everybody to this webinar with Gary Langley, the Scruffy trader. And he'll introduce himself better and more deeply, but I believe we will have a lot of very powerful content with him. And just so you know, this is going to be the first of 3 webinars Gary's going to deliver. So this one is going to be also publicly released. It's going to upload to our YouTube channel. The other 2 webinars, they're going to be just for the Fiverr traders. Okay, so you will have access through your dashboards if you have an active account. So those will be more exclusive content. So we'll give them to active traders. Just one request for everyone, guys. If you're going to be typing in the chat, make sure to change your settings so everyone can see what you type. If you leave it just for host and panelists, only myself and Gary can read, but not everyone sees your questions or what you're typing. And Gary is going to get started, and then at the end, there's going to be time for questions. That being said, I think, Gary, all yours.
Excellent. Well, hello, everybody, wherever you are in the world. As Sol was just rightly saying, this is the first of 3. Now, this one is based on journaling and the importance of a journal. The second one is more risk management, how to scale into a trade, but also reduce exposure and increase profitability. And the last one is a battle-tested strategy that I use personally, and you'll have seen it in my results. So why do you trade? We want money. And if you want money, are you going to get it off a whim? No, probably not. You need to plan it. And anybody who's been in business will understand that. Because if you're taking an investment on, you want a return on that investment. So are you going to gamble? Of course you're not. That's what journaling is all about. So what you want to do is sort of ask yourself a question. And that simple question is, how do I succeed? It's planning. That's the way I look at it anyway. So as a journal, the easiest way I can do this is to take you through one of my journals, because it's not only recording my wins and my losses, it's actually a tool to enhance my trading, my business plan, and ultimately make me money, because I believe that's what we're all after in the first place. So let me just show you something for a little bit. Now, many of you that are in here, I've recognized some of the names, will know me. And for those of you who don't know me, I've been around the markets in excess of 15 years. And the last 5 years has been my sole income. And I'm pretty well known as the scruffy trader. Now, if you haven't come across that name, tap yourself into YouTube and you'll see me on a daily basis. Okay. And within that community, I was asked if I would build up small accounts. And I said, certainly would. And you'll see the journal I'm about to show you being built up month by month. And it really keeps me grounded, because as a new trader, a lot of the time you don't bother with a journal. In fact, the first question you ask is just, show me a strategy. I'll be all right if I've got a strategy. But what if you don't know how that strategy works? What do you know about its win rate? What do you know about its profitability? Unless you've wrote it down, you don't know anything. It's just a guess. So you fall into what's called the treadmill of terror. And the treadmill of terror is something that is terrible for a new trader, because you'll have a little session and you've seen a basic strategy, could be moving average across for argument's sake, and it'll work for so long, so you're here with your strategy, but then it fails, so you panic. And what do you do when you panic? You look for a new strategy, and that works for a little while, and then it comes down and you fail, loses. You lose your money, you blow your account. You don't understand why, but you need a new strategy. So you get a new strategy, and it does the same. And then it does the same. And all you're doing is going round in circles. And the reason you're going round in circles is you don't know why it failed in the first place. And this is why a journal is so important, because as a tool, it's not there to focus on the wins. Because when you first start, you'll be typing all of the wins in and you'll be thinking, get in, look at that. Fantastic, I'm king of the world. But then when it loses, you're disheartened and you don't journal. You push it to one side and you're back on your treadmill because you're scared of the charts. You're looking for that holy grail. But if you read through your notes, the journal can emphasize not only your losses, your wins, but conditions. And if you can read the conditions of the market and know when to apply the strategy, you'll become more and more profitable. And I hope this makes sense. I'm not the best public speaker in the world, but I'll do my best, because ultimately I'm a trader for a living. I'm not an educator, and I'm certainly not a marketer. And I followed the same journey that you guys have. In fact, I'll show you. Give me just a second while I figure this out. Okay. We should be able to see a screenshot of my statements. And excellent, it's working, brilliant. Now, this was the first challenge that I took, or it's certainly one of the challenges that I took. And you can see that it's got a decent equity curve in, because I'm very cautious about what I trade. Now, in this, I did 717 trades at 89%. And I kept the profit factor above 1. Now, they also say, don't show it once, do it twice and take pictures. So I did it again. The equity curve here, all right, took a little bit of a slam. Journal showed me what was going wrong, corrected the errors, and back on the journey. Again, 413 trades at 85%. So I thought, right, I'll do it again. 324 trades, 89%. Can you see the importance of a journal here? It kept me grounded. And if you look at this one, it shows the day rates as well. I don't lose many days because I'm looking at the right conditions and I'm putting the right strategy in for the conditions that's in front of me. And I only know that because I've logged it. And I'll show you the journal in just a second. Now, when you see statements like this, and just to kind of put to bed a myth about prop firms and everything, I put a lot of trust in the 5%ers because they are the ones who are ultimately paying me. And people often ask that, do they pay? Do they pay on time? Well, I journal all my financial records as well. And there is the 5% is paying me each month on time, regular. So I know I can trust it. Keeps me motivated. That's the money. That's the goal the journal was getting to. And then you piece all of these together and it gives me my current status, which is this movement here. And as you can see, not a lot of downtime in it. And it all comes from the importance of journaling. So let me show you a journal. And the easiest way is to talk through this one. Now, in the YouTube community, as I was alluding to earlier on, I was asked to build up a small account. Now, what we're looking at here is what I call a Morningstar account. It's traded just early morning. I'll go through that in a second. And the idea is not to be greedy, but just compound. Now, my journal is broken up into tools as well as recording elements as well. Now, what we're looking at here is the summary. It's then broken down into a compounder, a wage maker, and then finally the journal part itself. Now, if I start with the compounder and explain what the elements are, it might actually, hold on a sec, I might need to switch this over onto a different screen. There we go. Can you see that now, guys? Happy days? Should be. Yeah, brilliant. Yeah, with technical, I might be good with the charts, but me and the mouse, we're not friends at times. What I'm driving at with this one here, just to flick back, it's built into 3 elements. We have a summary page to give you an overview of what's going on. We have a compounder and a wage maker. Now, they're the tools that help define my goals. Then we have the journal itself. Okay. Now, why would I have a wage maker and a compounder in the first place? Well, going back to, like I was saying, this is a sheet that is currently being used as an experiment to show an account being built up from scratch, because it's very good to show you big figures and kind of dazzle you, like the equity curve that I just shown you. I mean, that's done 30 grand in 2 months. Most of us are on a journey when we start at being very small. And that's when the journal is most important, because you need to know you're on the right path. Kind of give an analogy of some sort. If you can imagine you're driving to work each day and you're driving along the road and you hit a pothole and it bursts your tire. But when you hit the pothole, you notice there was a pub on the left-hand side of the road. So you repair your tire and you're going to drive down that same road the next day. When you see the pub, you automatically know there's a pothole in the road and you don't want to damage your car. So you'll take a maneuver on the road to avoid the pothole. You think you're safe, so you accelerate and you hit a cattle grid and it rips your tires up. But on the other side of the road is a bus stop. So you've now made a mental note of the bus stop. So on the 3rd day, you drive along, you see the pub, you know there's a pothole, so you know what to do. You drive along, you see the bus shelter, so you know there's a cattle grid, so you make adjustments and you carry on. Can you get what I'm driving at here? If you have mental logs, you can react to what you see. This is what this journal does. It's all about road mapping and helping you move forward. Okay, so the three elements are the tools. Okay, so when you first start, you don't really know where you want to go. And if you don't know where you want to go, you can't target. So the easiest thing to do is set yourself a place where you want to be. So let's just say you've only got, I don't know, we'll say 500 quid for argument's sake. So you can drop £500 into there. Now I break trades and I like to break trades. Reason being, I could have a target set here. Market comes up, hits the target. What if it keeps on going? Have I missed some money? Yes, possibly I have. So that's why I have these bits broken up into different areas. But to case in point, let's say I'm just on a pounder point. I'll keep the figures relatively simple. And I want to double my account. Okay. I can leave it at a pounder point, just here, and have one position open, look for 10 pips a day. This is going to work out how long it's going to take me to get a doubled account. And what I'm doing with this is I'm increasing the bid size ever so slightly each time, compounding the bid rather than the overall size of the account. That makes it manageable. And this will come apparent when I go on the journal itself. But let's just say I'm looking for a bigger target, a larger target, but I want to be risk-free at 10 pips. Well, instead of increasing your position size for whatever reason, your margin might be able to take it. So you might only have a maximum of a quid. You can put in some extra take profits, 10, 15, 20. So it might run 5 pips extra or another 10 pips extra, and have 3 positions running. Right? So what you would do at this point, you'd kind of pull that into risk-free as soon as that target has been hit, and then see if this will run any further. Now, your journal will tell you how many times your target runs past your initial target. I often only target 10 to 20 pips, but the market will run 30. So I always like to have a runner, which is why if you go and you see what I do, you see me with multiple trades on the screen. It's because I break up a single position and it helps me, reduces exposure, increases the target. This is something we'll go through in the next webinar. So in this, it's 33p position, but instead of getting my £10, I get 15, and it helps me. So I hope that makes sense. It helps me guide how I'm going to compound it. Now, once I've built an account up to say a level where I want a wage, that's where Wage Maker comes into it. And the Wage Maker is the next part. This is for longer term planning, how far I want to go with the marketplace. So let's just say I want, I don't know, 10 grand. 10 grand's a nice round number for a year. Now I work on 48 weeks of the year. The reason I work on 48 weeks of the year is very simple. I don't want to work every single week. I'm going to have holidays. It's going to be Christmas or whatever faith holiday happens to be. And sometimes I do like to go away. So take 4 weeks a year off, work on a 48-week year, the same as a job, because that's what trading is for me. Trading is my job. Okay. So if I put in 10 grand into this, this is all auto-populated. And the sheet that you're looking at, I will make it available to the members of the 5%ers. And if you're not a member of the 5%ers, do go over to the YouTube channel. Anybody that's a member and subscribes to the channel will get this sheet free. Okay. And if you're not a member, drop in the description. You'll find a link for the 5%ers with a little discount code on it. So that'll help you pennies. Just to happen to see it in the chat, but I'll come to the chat at the end. Okay. So 10,000. Well, Sounds daunting, doesn't it? 10 grand in a year, but I've only got £1,000. How do I get there? It's not as hard as you think. So if you think to yourself, you can average 20 pips or say 15, go in the middle of the compounder that I've just been saying. So your average win is 15 pips a day. How many times can you trade a day? Or maybe you'll trade once or twice. Now this journal is based on once a day, just once. But let's assume you can do 2 trades a day, one in the morning, one in the afternoon. And I want 10 grand. Well, it's only £1.30 a pip. Now, what this is illustrating, and it's a very simple illustration, you don't have to swing to the fences to make money. Because the trouble with new traders is they look for quick money. And quick money never wins. Because one, you'll get excited over and over. And you will up your position size unnecessarily. And when you do that, you'll put stress on the account. And it takes one bad trade to wipe that account out. But if you've got something like this, where it can ground you, and you know what the longer term goal is, it'll stop you blowing your account up. Why? Because you're only trading at £1.30 a pip. And then you just have to do that twice a day. It ain't difficult. And you can break it down into anything you want. So say even just 10 pips. And let's see what that comes down to. So £4, it's not bank busting stuff, but you only have to do it once a day. So if you're looking at, say, cable, DAX, FTSE, pound JPY, any one of those products will find you 10 pips in a day, and it'll give you 10 grand a year. Now, 10 grand a year is a big difference to most people. Buy you a car, certainly buy you a holiday, and it's all in the planning process. Now, this is before you've even looked at a journal itself. What you've done is you've roadmapped where you want to be. And I hope this is kind of coming through and hitting home, because too many times traders go to market without a plan. And if you take the 5%ers as an example, you have certain criteria that you have to achieve for your funding. That is your plan. You can then break it down using a compounder and a wage maker to what you need to do each day. And if you do just a tiny little bit over the top each day, it starts knocking days off the clock. The journal is give you that. So what is the journal? Well, let's have a look. Well, the summary is exactly what it says it is. It is just a summary of the growth and keep you on track and give you a little bullet point for the month coming forward. And with this, it's a financial summary telling you whether it's good, bad, indifferent, how good your win rate is, and where you are to target. Simple stuff. But then you go into the journal itself and you kind of flick through, and I'll take you through the elements of it, and then you'll be able to understand what it's all about. Now, it's all self-populating the way that I do it. And again, it's broken up into key areas. We have the financials on this side, your rules and your targets. And the way they work is it always sort of adds up as it's going. Now, you'll see I have 2 balances. I have a gross and a current. And they're there because for all I'll be drawing profits off this, I still want to know if I'm moving towards my overall goal. So down here, it's telling me I can have a profit split from the current profits that's there of £22. Okay. Why is that? Because if I take half the profits out, it means when I start the next month, my starting balance is starting with a bigger balance as well. So for argument's sake, if I take 22 out of here, just drop it in, you'll see this bit changes, but that bit didn't. Again, it's a visual aid keeping me on track. This tells me what my current P&L is for the month, what my percentage growth is, how many positions I've taken, what my win rate is. Now within this, I have a mini compounder, which is based on this, because I want to keep an eye on what my position size is. I don't want it to go out of hand. So again, here, it's telling me it's 59p, but one of my rules is if I've hit 10 pips, I can increase it. So it'll increase by 62, letting me move up. Gives me another visual check. What my average win is, what my average pips are. Helps you focus. Your rules help you focus. Now this is based on trading once a day for a couple of hours before I go to work. So my first rule is between 6 a.m. 8 a.m. I'm using a particular strategy which is called Morning Star. Now yours could be anything. Morning Star is just a momentum push strategy off a key level. Very, very simple. Looking for 10 pips off a single move. And I'm only looking to trade the markets that are active at that time. Again, because it's in front of me, keeps me in check, stops me chasing around the market because I know what I'm focused on. And then I always have my little mottos, less is more. And less is more is very simple. The more you're in the market, the more you're at risk. And score, score, stop. If I trade twice, I quit. Why is that? The more I'm in the market, the more I'm going to lose. Less is more. Simple. Then we come down into the targeting. I want to keep an eye on what the targets are. I know if I do 1% a day on the account, roughly, it's giving me 617, average 20 pips, I'm fine. It's all about being focused. And that's just the top section. But then you need to be looking to fill in the journal itself as you go. And it's about as simple as it gets. Now you'll notice I don't put risk on this because I think risk is a bad word. I prefer to call it investment. And that's probably because I come from a business background. I'm looking at what's called ROI, return on investment, because I don't really believe in risk. You shouldn't be risking anything. You should be investing to make. And this journal helps me. So on this, if I just sort of key in a figure for argument's sake, it's currently at 6153, just above there. I will invest for the day 5% fund. That's all I've got to play with. If I lose it across 2 trades, I've only lost 5%. Now I can have whatever figure I want in there, you know, but again, it's focusing me and calming me down and stopping me putting the account at damage. I can then just drop in what my position size is, and it'll automatically work out the breadth of the stop, not where the stop has to be, but if I use all of that 5% at that position size, this is the breadth of the stop. So I would then need to go to the chart and look where a logical stop is and see if it's within that breadth. If it is, fine. If it's not, I have to either adjust the position size or not take the trade at all. Stops me getting on the treadmill of terror. Then if you win or lose, you drop it into here, say we won a tenner. It'll tell me I've won, it'll tell me the balance change, give me a rough idea of the risk reward. Now, risk reward is a strange concept because if you're swing trading, you always want to be on a high risk reward. If you're day trading, I'm not too worried about an inverse risk reward because the markets oscillate very quickly. And it's just part of the course of being a day trader, scalper, whatever you want to call it. But you still got to control it and make certain the trade was correct in the first place. And again, this is helping the way through. And then on this side is where the journey, or the journal rather, comes into its own. You need to know the market you're trading. You want to know what you were trading at the time. So in this case, it's cable, the morning star, went long, and I was in a good mood. Why on earth would I put mood on a sheet? Well, it determines whether or not I was trading from a place of emotion, which is terrible, or whether I was planning it. So if I'm in a good mood, I'm calm, everything was in alignment, good to go. If I was tired or anxious and I lost, was I just taking out my anguish on the markets? And then finally, why you got into the trade in the first place. Was it on the key level? Was it a fib? Was it a bolly bounce? Whatever. Something to help you focus. So that's how I work a journal and why I work a journal. And as you move through your trading career, you don't want to journal less. You want to journal more, because it will help you fine-tune constantly what you're doing. And if you're on a good spell, still record it. And more importantly, if you're on a bad spell, read it. Go back through your journals and you can understand, have the conditions changed? Have you changed as a person? You know, is your mental state correct? Are you getting too ambitious with your position sizes? All of these different things. So that's my journal. That's kind of my thoughts on it. I'll drop in the chat and I'll see if there is any questions, and I'll try and answer them best that I can. And then I'll hand it back over to Sol. So fire away, guys. I'm here for as long as you want. So let's have a look. So we've got Yanis. Hello, Yanis. Compounding, eighth wonder of the world. It is. Einstein said that. But if you're in 1933, it was King Kong. So does the bid size mean lot size, Brian? Yes, it does. I use a spread betting account mainly, and it's often called a bid size. It's just price per point or price per pip. Okay. Could you share the spreadsheet? Put my teeth back in. The spreadsheet is available to anybody who subscribes to the Scruffy Trader and is a member of the 5%ers. And I'm sure Sol will sort you out. I'll pass it over to him and make it available to you guys. And I think that's it. That's the last of the questions. So happy days.
Wait, okay, so if there's any more question, guys, this is the moment before we wrap up. As Gary said, the spreadsheet will be available in a few days through your dashboard. So if you have an account with us, you will be able to download it from there. And as we said at first, at the beginning of the session, the next webinar with Gary will be in 2 weeks, if I recall right. So keep, just keep posted for are there days with no trades. That's for you, you guys, Gary?
Yes, there is. Again, it comes down to your rules, Enrique. Never force a trade. Now, with Morningstar, for argument's sake, the sheet that I was showing you, it was trading between 6 and 8. Now, if you're working, that's a good time to trade. You know, you put your trades on before you go to work. But if the setup doesn't come into play, sitting on your hands is a position. It's a scratch position. You haven't made anything, but you haven't lost anything either. But what you can do is you can write that down as well and just say, well, it's a scratch trade today. Why was it a scratch trade? Well, limited liquidity. The markets weren't at a level, whatever. But then you would know why you didn't trade on that day. Now, another reason for not trading is you might be tired, angry, and you've decided you don't want to trade on that day. So you put that in as well. And what it'll do is it can start helping you sculpt your lifestyle. Because if you are tired and irritable at 6 in the morning all the time, go to bed earlier so that you're nice and refreshed. That's the way I would look at it. Okay, so where else are we up to? Samuel, in the notes on the spreadsheet, inform 6 to 8 a.m. Yeah, I break my days up personally. I normally start trading around 9 a.m. in the morning for my standard job. Why is that? Well, between 6 and 8, I'm normally preparing the charts ready for the day. I don't trade the opens. Now, I live in the UK, so the open for me is 8 o'clock, and it's very volatile. And the markets will often go one way before they go the next way. So I like to sit out of the markets then, and then I'll trade between 9 and 5. That would be sort of my London session, and ideally I'm paid within that. Now, if I'm not, I normally don't day trade. So that goes back to the other question about missing days. If the markets don't offer up anything, I'll sit out of it. And then the next part of my day, at the end of the night, as you'll see in the battle-tested strategy, I sit down, I look at the day charts at around 8, 9 o'clock at night as the markets are calming down, and I prepare swing trades. So yeah, time of the day is important. So let's have a look, see where we are. Do you trade at 7 a.m.? Yes, I do. I'm very wary of 7 a.m. Well, I'll rephrase that. I'm very wary if I'm trading European markets at 7 a.m., like the DAX, because they open up. Their open is 7, and the DAX will spike at 7. And you need to be a little bit careful for that. So at that time, it's not as violent as 8 o'clock, but it's violent enough to keep an eye on it. So what I have a tendency to do is let a 15-minute candle close, see what it's done, and then trade it. Okay. MetaWorks, hello there. What are your thoughts on backtesting? Definitely. But there's backtesting and backtesting. And I know that sounds odd. But backtesting, you can actually go too far back in time. Around 12 to 18 months is pretty good, because that'll show you the bigger long-term conditions in the market that's happening now. If you look 20 years ago and you're working your way through it, well, God only knows what's happened over the last 20 years. You can come into 2008 and find the market crash. There was another one in the UK in 2016 when Brexit was around. We've recently had one 2 years ago with COVID. All of these things throw the market into sort of chaos, but they are unnatural events and they don't happen all the time. So when you're backtesting, about 18 months is sufficient. Okay. And I see you don't usually target 50 pips or above. Well, that's to do with breadth of market, because when you're day trading, if you're swinging for the fences all the time, 50 pips is a lot in a day for a single move. Now, the markets will oscillate like so. And there's nothing worse than watching the market move up 25, 30 pips and you think, yes, this is in, comes all the way back down and you're only a few pips in profit, then waves its way back up. Well, if you can get your money in the first 30 pips, fine. Take the bulk of it out, let it come down. This is where breaking trades helps. Leaves you a little bit of a runner and you can always enter back in. But how many times have you entered the market and you've seen it do that? I see it all the time. So I keep it conservative based on an ATR. And the way I work the ATR out is very simple. Don't look for the bottom third. I don't look for the top third. I look for the bit in the middle. Cable has an average of 100 pips a day. So that's like 33 and a third. So 30 pips is about right. Break it down into sort of little bite-sized chunks, 10, 20, 30. Makes life a lot easier. Okay. So does that make sense to you guys? Yes? No? Different? Oh, yes. Hello, Mohammed. So good stuff. But ultimately, at the end of the day, as I said in this, I'm a trader. You know, I'm not here to market anything. I'm just kind of trying to give you some experiences. You know, when we go into the next webinar, it's where I kind of get into a little bit more of how the mechanics of trading work, you know, because strategy is one thing, but managing your trade is something completely different. And there's more money made from the management of trades than any strategy. And all strategies work. You just have to know when to apply it. Oh, or am I wrong, Sol?
No, that's wisdom. Wisdom in there. Yeah, guys, make sure you attend next webinars. I think Gary will disclose a lot of things we don't get access as retail traders, and techniques on risk management that will be very helpful for you. So
and I think there's one last question here.
Okay, let's take it and we'll wrap up afterwards.
Just seeing it come in. What is the importance of risk-reward ratio? Okay. It depends on your point of view. Now, as a day trader, you can have an inverse risk-reward, but you need a higher win rate. So one counters the other out. If you're going for a multi-day to multi-week, a swing trader, your risk-reward has to be in place. And there's a very good reason. I can tell you what's going on pretty much over the next 8 hours by the conditions on the market. So what I'm looking for in this instance is its directional bias is greater than risk reward, because as long as I've got the bias right, it can move in a little bit. And we've all seen big wicks come down, take us out and go back up. So I look at the investment as I was showing you on the sheet. And as long as it's within that criteria, I'm happy. Now, when I'm swing trading, I'm the other way. I'm looking for 1 unit to get 2 to 3 units. And it's all about your frame of mind, because I'm of the opinion that tight stops don't work. And well, I've kind of proved it over the years, but that's just because it's my style of trading. Everybody is different. I need to be winning more than 50%, because if it's below 50%, I think you're gambling. If you're over 50%, you are trading. That's kind of the way I look at it. So it's horses for courses. But I think you can get too hung up on a sort of 1 to 3 risk reward and force a trade that isn't there. If you want 1 to 3, read the conditions. And if the conditions don't line up to that, don't trade it. And your journal will tell you that. Let's have a look. Yes, I do believe there'll be a recording of this summit. Samuel, do you use Bollinger Bands to trade? Right, we're coming off subject a bit, but yeah, okay, I'll go with that. I use Bollinger Bands all the time. They are a perfect tool to show you stretch points of the market. The basic tools are all you need. Bollinger Band, moving average, Fibonacci, RSI, perfect. I do put pivots on from time to time, Anthony. They're very good. Just as a quick tip, on a daily pivot, if it opens below, it'll attempt to get to S1. If it opens above, it'll attempt to get to R1. It binds the trade. They're quite useful, especially if you're a little bit unsure of your direction. And happy days. There we go, so a couple of extras.
Fantastic. Yeah, it's all adding value. Fantastic. Thank you. Traders, thank you very much for coming and for staying. Thank you very much, Gary. I appreciate all the content you're delivering. Very, very unique. And guys, make sure you attend in 2 weeks. We'll post the times and the hours and everything will be posted. So just see you soon, I guess. Thank you, Gary.
Anytime.
Have a nice one.
Here's all right.
Bye-bye.